a real estate crash in 2023. Is it going to happen? Let's look at the data. All right, Paul, the virtual investor here. Welcome back to the channel. Today, what I want to unpack, and I'm going to share with you some data here from Freddie from the St. Louis Federal Reserve. And we're going to take a look at that and unpack it and see what we got. Are we heading for a crash or are we not? Is this all just a bunch of propaganda being put out there by alarmists? Where are we heading in that direction? Let's really analyze and scrutinize the data. All right, great resource here for everybody looking here at the St. Louis Federal Reserve. And the data we get here tells me a lot. And again, this is Q3 to Q2 for real estate. Okay, so let's look at this here in 2022. So if we unpack the numbers, I actually like it looking at the transactions separately. You can look at the cash transactions, FHA and VA mortgages, and they tell you a lot. And this will explain a lot on why people don't like to take FHA mortgage buyers, not just because they can be difficult with multiple appraisals at times. Chipping paint can be an issue, and all the little things they can pick apart that cost home sellers more to remedy in order for the deal to go through. Plus, the process generally takes longer. You know, conventional can get mortgages done generally in 30 days, whereas FHA, it is more of a 45-day process and can take 60 days at times. All right, so let's look at the numbers. When we look at cash transactions that happened here in from Q3 to Q2, so we got 494,000 up from 455,000 in Q2, which shows one, the inventory was still really low because the market was hot and people that were cash buyers were beating everybody else out. But if you'll look at it, it's going to be lower than a conventional mortgage buyer, right? They're getting a little bit of a discount there, maybe a few percent. So if you look at the numbers here, the increase from Q3 to Q2 was 8.6%. Okay, now let's go to conventional financing from 503,200 to 478.8. That is almost 12%, 11.99% increase. And mind you, in Q3, we had really high rates at the very end of Q3 there in September. So that's going to kind of skew the number a little bit there. But I was surprised to see it go that high. Then go to FHA buyers, which again, there are a lot of. So this is going to push the overall numbers down. Went from Q2 of 354,600 down to 340,300. So the numbers were lower. Again, with FHA, you're buying smaller homes and homes that are less expensive because of the thresholds. So actually you had a return that dropped 4.03%. The price dropped 4.03% on FHA mortgages. Now let's go to VA. VA is similar to FHA, but it's a much better mortgage. It's truly 100% mortgage with no money down. So numbers went from 418.3 in Q2 to 432.2, an increase of 3.3%. So a pretty good increase there. So you look at these numbers, what it's telling you, we're still increasing even when rates were increasing. And again, the factors are limited inventory and there's still demand. There's still pent-up demand, not as much as there was when rates were 2.75% or 3.25%, but there's still demand. And what that's telling me, again, we don't have Q4 numbers here. I'm sure things are going to drop a little bit here. And I'm going to go to another chart. It's going to show you where the numbers ultimately were during the year. But I think we're still in solid standing right now. We'll see if rates continue to drop, you know, they're in the sixes now instead of their lower sevens. That helps. If we get to the fives, we're going to have another, I'll predict it, buyer frenzy. And it's going to be a shorter term one. It'll be a burst, but it will be a buyer frenzy. All right, so let's look at the next chart here. This is interesting when you look at it through time. So you go through the 60s and 70s. Remember, 70s were high inflation like we got now, and into the 80s, high inflation. But look what the price keeps doing. Even in high inflation times, the prices are going up. They're continuing to rise, slow and steady, but a nice rise. And we had a little drop off here. Savings and loan, you see this little blip here, that was a savings and loan crisis, which pushed numbers down. Remember that well. And then steady, nice, steady increase is what you like to see. And then, of course, we had the crazy loans, the ninja mortgage loans, the liar loans, they call them, which brought a lot of turmoil here into the early middle 2000s and then to the financial crisis in 2008, which hammered down. And then we had a liquidity issue and the prices dropped. And ultimately they fell and started going back up in 2013. 2012, 2013 was the bottom of the market. Then we had nice increase as mortgage rates had dropped, right? And you had great mortgage rates from, let's say 2013 all the way till 2022, early 22. So you had COVID, the COVID drop here, right? Coming down, bang, that dropped it. But then a meteoric rise, way too much, way too quick. We haven't had anything like this, right? This is that hockey stick type of thing. But let's unpack the numbers. If we look at Q3 2022 median price, 454,900 compared to the Q2 of 449.3, you had a 5.03% increase. Nothing huge, right? That's a nice sizable increase, but it's an increase even with higher rates. And you go Q1 to Q2, and you have a 3.74% increase. And then when you go year over year, again, I'm looking at quarter to quarter here. When you go year over year, 2022 Q1 to 2022 Q1, you have an increase of 17.11%. Ultimately, that's what we had in 2021, a 17.11% increase in real estate. And then you go to quarter, but year over year, Q2 compared to 2022 compared to Q2 of 2021, you had a 17.43% increase. This is where you're going to start to see the difference. And this is where maybe we got a trend happening that we really got to keep our eyes on. Go to Q3 of 2022 with the median home price of $449,300 compared to Q3 of 2021 of 411.2, your year over year return is like 10.63%. And now I'm going to project a little bit here because I'm just going to go off and let's just say Q4 2022 was the exact same number as Q3 of 454,900. Could be slightly less, could be slightly more, but it's going to be somewhere right in around there. If we take that, divide that by Q4 2021 of 423.6, we got a 7.4% increase for the year for 2022. So ultimately, nowhere near as high as the 2021 was a 14.5% increase over year over year for the year of 2021. Real estate went up 14.5%. 2022 is 7.4%. So about half of 2021. And they're predicting, a lot of analysts are predicting flat, around zero, some minus 10%, some minus 5%, some plus a couple of percent here, depending on which one you looked at. And we'll unpack some of those in future episodes here. But if you do that same trend and you drop about half, about another 7%, you're gonna be fairly flat. Look, as real estate investors, if the market's flat in 2023, that's great. What we're gonna do is push out a ton of competition, and we're going to be able to get much better deals at much deeper discounts with a good idea of what we're going to sell the property for. It's not going to change. You look at the ARV, those are prices now. And what you want to do, just be safe, is account for a slight 5 to 10% drop in the market. And if it doesn't, if it stays the same, you're in good shape. Sell it. It's going to take a little bit longer. Your holding costs are going to be a little bit more. But ultimately, you're going to be able to sell. You should be in good shape. That's the way things are looking in 2023. I don't see right now, pending any kind of a strange unforeseen event, I think we're going to be pretty solid as investors. We can feel pretty confident we're going to be able to go out there and get some better deals than we have in 2022 and 2021 and 2020 and make better returns. Maybe you're going to do a few less deals. I don't know. Maybe you could do more. Opportunities can be there for you to do more if you increase your marketing costs or increase boots on the ground, depending on what type of tactic you use, whether you're doing auction properties like we do, whether you're doing direct mail, direct to seller like other people do. But ultimately, I'm looking at 2023 as a good solid year with anywhere from no gain to maybe 3 to 5%. But again, it's going to be a fractured market. It's going to be market dependent. Where are you buying? Are you buying Phoenix, Arizona, where the market should go down? Boise, Idaho, same thing. Southern California may as well. Other markets are going to be hit. Different Austin, Texas, another market that may be hit. And then you have markets like the Carolinas, Tennessee, and Florida and Alabama, where they may still go up. So it's going to be really market dependent and inventory driven. Remember to keep your eye on the weekly inventory, because that's going to tell you a lot. If you see spikes in weekly inventory, big red flag, you're going to want to pull back numbers, scale back a little bit. But those are things you want to keep your eye on as investors. Hope you guys enjoyed this. If you do, make sure you click on the like button and subscribe to the channel for more future videos. Take care, guys.